For decades, venture capital has played by a simple, brutal rule. Most startups fail. But what if that's not a rule? What if it's just a bad habit? Today, we're going to break down a venture model that's trying to engineer that failure right out of the equation.
It all starts with this number, 60%. In the world of venture capital, that's the accepted failure rate. It's the cost of doing business, the chunk of your portfolio that you just expect to go to zero. And for a long time, we've all just kind of nodded and accepted it.
But this right here, this is a direct challenge to that thinking. It reframes that 60% failure rate not as a law of physics, but as a problem to be solved, an unacceptable outcome that points to a flaw in the system itself.
So, let's really dig into this 60% problem. Why has it been such a fixture of the venture landscape for so long? Well, it turns out it's baked right into the DNA of how we build portfolios and how startups are told to operate from day one.
This is the classic power law portfolio. The whole strategy hinges on the idea that you can afford that 60% loss because the massive returns from that tiny 10%, the home runs, will more than make up for it. You're basically hunting for a unicorn, and you accept that you're going to find a lot of duds along the way.
But what if that 60% failure rate isn't just about bad luck or a bad idea? What if it's a direct result of how startups burn through their single most important resource, cash?
And this, right here, is the main culprit. You've got brilliant founders building a product in isolation without any real customer validation. Then, they take that seed money and pour all of it into Google and Facebook ads, desperately trying to buy a community that wants what they've built.
This really lays it out, doesn't it? It's a two-step dance to disaster. Step 1, build the thing. Step 2, burn every dollar you have to find people who might want the thing. This sequence is what torches a startup's runway and puts its survival in serious jeopardy from the very beginning.
Okay, so if that old way is so broken, what's the fix? Well, the solution is to take that script and just flip it completely on its head.
The core idea is called Zero-CAC, or Zero Customer Acquisition Costs. And no, it's not just about getting cheaper ads, it's about a fundamental shift in strategy. Instead of building something and then buying an audience, you build the audience first. You bring them in, you get them excited, and you turn them into your co-creators.
And here's what that looks like in practice. You start with a surge, growing an authentic, engaged community around a specific problem or idea. Then you invite the most passionate members to become design partners, helping you co-create the solution. So by the time you're ready to launch, you're not launching at a market. You're launching into a pre-qualified market that's already waiting for you.
So let's talk brass tacks. What does this actually mean for a startup's chances of survival? And for an investor, how does this de-risk the investment? Well, the advantage is direct, and it is quantifiable. This right here is the bottom line. By completely wiping out customer acquisition costs, a Zero-CAC startup gets a 3 times longer survival runway with the exact same amount of funding. Think about that. That's 3 times more time to build, to pivot, to perfect the product, and to ultimately win.
This massive advantage really comes from 3 key benefits. First, capital efficiency. Every single dollar goes into building the tech, not feeding the ad machines. Second, radical transparency. You're building in public with your future customers, so product market fit is practically guaranteed. And third, velocity. You hit the ground running because you're launching into a market that you already own.
So, when you put this all together, what does it mean for an investment thesis? Well, it completely changes the kind of proposition you're being asked to consider.
It all comes back to reversing this one simple sequence. You're no longer backing a company that's built a solution and is hoping to find a problem. You're backing a company that first found the problem, built a community around it, and is now simply delivering the solution that community asked for.
And that's the real kicker. This isn't about betting on a long shot anymore. It's not about trying to find that 1 in 10 statistical anomaly. This is about partnering with a process that has systematically removed the single biggest risk factor, market demand, from the equation. You're not backing a gamble, you're backing an engineered certainty.
So it leaves us with one final, pretty straightforward question. When the greatest source of failure in early-stage investing has been taken off the table, the decision to invest starts to look less like a bet and a whole lot more like a logical conclusion.